let's see about the question of why you can't stand still in this world. Ultimately, inflation is key to this. Inflation is the thing that undermines the value of everything you have on a daily basis. It undermines your earnings. It undermines any money that you have sitting on the side, so your capital. It also undermines assets that you already own if they're not appreciating. So you need to make sure that you have your money in the right place. Savings part of that, and certainly for you to be able to plan for the future, setting aside money is the right thing to do. But setting aside the money and putting in a bank account that doesn't pay anything, or setting aside money and putting it into a low paying savings account may not necessarily be the right thing to do. It may be, it really depends on your risk profile. Part of it comes down to inflation. And as you can see here, this is the relationship between both earnings and inflation. So real earnings, if you take your earnings growth and you take away the growth of inflation, where do you lie? I've just given two examples here, which are the United Kingdom and the United States. And what we can see here is there are fluctuations, major fluctuations, but certainly extended periods of time where you are losing money in terms of how much your earnings are going up or down over time. What's nice is when you get at the end of the year and you're given a pay rise and it feels good, but a lot of the time that pay rise doesn't match inflation. And that means that you're actually moving backwards in terms of your quality of living. What's key to this is being able to set aside money and then perhaps invest that into something that pays over and above. And this highlights exactly why sometimes you might see a interest rate. Let's say a bank gives you a fixed interest rate of 3% for the year, for example, and you might think that's not bad. It's guaranteed, it's no risk, but you have to factor in the rate of inflation. And if at that time you have a relatively high rate of inflation where you are, then all of a sudden a, say, 3% return could essentially mean that you're flat on the year. You could ultimately be losing out when considering inflation. Or if you have near enough no inflation, then perhaps 3% is a decent return. So always look out for the rate of inflation expectations, alongside the rate that you're getting if you're looking for guaranteed returns on investment. This shows you two different things, right? And it essentially highlights the importance of investing in itself. And that's the Fed funds rate. And this is a proxy for the kind of thing that you might get from your local banks, right? Because ultimately, the interest rates provided by your central bank will be the basis upon which you then have greater information spread across the market. So let's say the 10-year yield in the US is informed by the Fed funds rate. The return provided as a sort of risk-free return from, say, your bank, for example, that's going to be a function of some of these key rates. And the Fed funds rate will be key to setting interest rates for your savings over in the US. In particular. So it's the same kind of thing for wherever you are around the world. Now, using that Fed funds rate as a proxy for the kind of rate you might get off your bank, even though a lot of the time they'll give you less than that, highlights that if you take away inflation, you can see a lot of the time you're not even above ground. So you can see that sort of dotty blue line in the middle. It's not very impressive return. If you do the same kind of thing and you put a year-on-year return for the S&P 500, you remove inflation, you can see here, you do see wider swings. And certainly we did see a significant period of weakness over 2022 and the like. And a lot of that came down to how high inflation came and the question marks around that period as well with the market. But generally, you can see it is in positive territory and you see much higher returns, often sort of moving up towards the sort of 20% threshold and the like. So ultimately, investing over time, just in the S&P 500 has proven to be a more worthwhile investment than simply going to your local bank and seeing what the risk-free rate of return is. And then taking away inflation, you a lot of the time will be back to square. You might be back to zero. You might be back to something below zero as well.